One of the hardest things about this last year or 2 years at this point has been just how brutal the losses have been. I mean, it's one of those things where I feel like you can never be reminded too often that bear markets stink and they can take your money. You have to protect yourself. And what kind of things have you been doing during this time to protect yourself? And again, I don't want to get too negative because we've got the follow through day here, but I think it's important to remember, just in case this doesn't work, what kind of things, what kind of guardrails do you have in place to protect yourself?
Yeah, the probably one of the most top 2 or 3 questions I get is just that blanket question. I'm sure you guys get it as well. When do you sell?
Yeah.
And I think of selling in 2 ways, selling into strength or selling into weakness. As far as selling into strength, there are a lot of great sell rules in the O'Neill book, How to Make Money in Stocks, in chapter 4th edition, chapters 9 and 10, I believe, or 10 and 11, right around there. A lot of great sell rules into strength. But I want to focus more on a lot of people have trouble stopping themselves out. I think it's one of the hardest things psychologically for people because of one basic concept of fear. What if I sell and it turns around? Some people might say taxes is a factor. I don't think that's that big of a factor from people I talk to. It's what if I sell the stock and it turns around? And speaking from my own experience, about 27 years of doing this, I struggled with that for the first 12 or 13 years. It's that shoulda, coulda, woulda. You just question yourself over and over and over until I finally decided you have to take the good with the bad. Meaning some stocks you get stopped out of are going to go significantly lower. And don't forget that, because we tend to think about the ones we sell that turn around and go higher, which you can always get back into. But I just accepted, once you make that decision and have some clarity, you got to accept some are going to go lower and some are going to go higher. And it is part of when you study some of the best traders throughout history in the Market Wizards books and so forth. Just like the top 3 rules in real estate are location, location, location. The top 3 rules universally of all the best traders throughout history are cut your losses, cut your losses, cut your losses. And it's very important, I believe, that traders need to implement that as part of their strategy.
So what is really kind of behind that? It's because it happens to everyone, especially when you're starting out, that what if I sell and it turns around and goes up without me? Right. What is, explain a little bit about the psychology and kind of the mindset of what newer traders are kind of struggling with at that point.
When I was a newer trader, and I hate to sound so simple about this, but it's just the fact is I just assumed everything goes up.
Yeah.
I remember some of the first stocks I
Wait,
bought.
did you start trading in the 90s?
That was like us. We were all in the 90s.
Someone started trading in the 90s with that mentality.
Yeah, you just assume, what do you mean it doesn't go up forever? And when you look at history, and I know the O'Neill book points out a lot of those big winners throughout history, but your likelihood of finding the next Amazon or Apple is very, very low probabilities. Like, to find a stock that's going to go up 10,000, 20,000% over 10 years, that's a very, or whatever, 4,000%. That's a low probability. So I just assumed everything went up. So I didn't understand. What do you mean cut your losses? What do you mean I have to sell something? What do you mean you ever have to sell something? And once you study history and realize that's not the way the market works, there are a lot of companies that come and go. You have to understand, after a big move, sometimes, you're just not going to get the highs, and you have to just to be happy with the profits. And sometimes, as David Ryan said in a recent interview, one key characteristic of successful traders should be humility. I think that humility comes with, hey, I'm just wrong on this. The market's proved me wrong on this stock, and you have to cut your losses as part of that.
And I think that's really kind of the basic thing that everyone first struggles with, is that you're going to be wrong a lot in this business, right? And so get used to it, make those mistakes, learn from those mistakes, and hang around long enough to survive, to profit in good markets.
Mm-hmm. I think sometimes we fall in love with stories sometimes, and
that's true.
We're like, oh, this is the next new cure for this, or this is the next new chip that's going to go into this, or the next new EV that's going to take over Tesla market, whatever the concept is. And we fall in love with those stories. And there's nothing wrong with developing your thesis. There's nothing wrong with having some conviction. But at the end of the day, you develop that conviction or that theory and let the market prove you right or wrong. And to your point, you have to accept you're going to be wrong more than you're right. And that's when the humility comes in to cut your losses.
Yeah. And that's hard for so many people because you don't want to look stupid. No one likes being wrong. And, if you're not willing to protect yourself from when you are wrong, I mean, that's when you're kind of asking for trouble. But yeah, I agree with you. I think, again, especially for, smart people, really, that aren't used to being wrong, that can even be a bigger issue. So
I
sometimes
mean,
Bill
hey,
was
if I
like,
can leave a positive message, the market doesn't care about us. And
yeah,
True.
it's
yeah,
just, I mean, I don't mean to be, no, I'm just, it's honest. Like, hey, but this stock is supposed to do this, but the market's supposed to do this. It's once you come to that realization, the market really doesn't care what your opinion is. And it's not to be negative. It's just a fact. And to get to your question about guardrails. So someone might say, okay, well, what would be your line in the sand? What would be your area that you just say, hey, the market's proved me wrong? And that's where I lead to the 50-day and 200-day, depending on your time frame. Those are good guidelines because statistically, traditionally, that's where institutions support stocks. And if the institutions are no longer supporting them, then I want to get out of the way.
Mm-hmm. So before we kind of get into using those as guardrails, are you typically only buying stocks that are above those levels?
Yeah, the studies show that 99% of the biggest winners throughout history start above their 200-day, and I think 92% start above their 50-day. So when I talk about strong fundamentals in the earlier segment and talking about strong technicals, it's assuming I'm buying. I shouldn't assume, but it's with the understanding I'm buying something that's already above its 50-day, that's coming out of a strong base that looks good technically. So almost anything I'm going to buy, unless it's a special situation, almost everything is above its 200-day with the 50-day above the 200-day. So they're going to most likely look good technically as well.